Today, Dave & Buster's released their second quarter 2022 financial results. And we're going to go ahead and go over that. This will be kind of quick. So, they had a record revenue of $468.4 million. And they're going to keep comparing throughout this report and their 10Q. They're going to keep comparing things to the second quarter of 2019 before Corona. And then also, they're going to compare to the second quarter of 2021, which that quarter, that year specifically, was really bad for business. So that's kind of why they're bringing up 2019 so far back. And you'll notice that they will not mention the first quarter of this year because they actually, even though the revenue is greater, the net income is less than last quarter. So let's continue. They completed their acquisition of Main Event on June 29th. So towards the end of this quarter, I think they are 3 weeks. On the conference call, they said they were 3 or 6 weeks into Q3. So this June 29th was just about the end of the quarter. Comparable sales at Dave & Buster's branded stores increased 9.6% compared to 2019, and Main Event increased 29.7%. And can't tell if that's just due to seasonality, the nature of being after coronavirus, or if management is that much better at increasing sales than Main Event's prior ownership. Net income totaled $29.1 million or 59 cents per diluted share. Last quarter, I believe it was. Actually, I have it pulled up here. Last quarter was 1.35 per share, and the revenue was 451 million. So, slight revenue beat quarter over quarter, but as you can see, less than half of the net income profitability. And then they're going to compare to 2021, and also they're going to compare to 2019. Let's see. During the second quarter, the company repurchased 764,000, basically 765,000 shares for $25 million. And they ended the quarter with just about $600 million of cash on hand, of liquidity actually, which is $100 cash on hand, and about $500 million of its credit. So they issued credit that they could use. Let's see, what do we have? I'm going to scroll past a lot of this. So a lot of stuff gets reiterated here. What I want to focus on here, we have the asset breakdown, and you can see that the total assets grows just about, would that be $1.3 billion? Yeah, this is in thousands. So the total assets grows $1.3 billion. The largest item being property and equipment, and intangible and other assets. And then for the liabilities, the long-term debt increase just about $1 billion. So, and lease liabilities increase about 300 million. So we can see how they were able to acquire Main Event, mostly with debt. And then here we have the food and beverage revenue, amusement and other revenue. I wish I would have pulled up the prior quarter. It'd be interesting to see. You know what? Let's see here. I'm looking for the first quarter. Yeah, here we go. I want to see, since they didn't let us compare here. Food and beverage. We know that amusement and other revenue is more profitable than food and beverage. So I want to take note of this percentages here. 33.7% for food and beverage for first quarter. 66.3% for amusement and other revenue. Okay. It's pretty much in line. No change. So we're thinking, how is the profitability not as high? So total revenue is actually a beat from last quarter. The cost of food and beverage, 29.6%, 28.5%, slightly more expenses for food and beverage. Total operating costs, 78.1%, 87.9% here. So higher operating costs. This is second quarter we're looking at. Let's see, net income here and the total shares. So even though they did buy back $25 million worth of shares, they still have an increase in diluted shares and basic shares. So they didn't mention in the pretext up there that they had sold X amount of shares. They mentioned that they did a buyback, but it definitely didn't outweigh the number of shares that they sold initially. And that is year over year. So if we look at, let's see, 49,271,000 as of Q2, 49,453,000 as of Q1. Okay, so this, keep in mind, this is a year ago quarter. It's frustrating they're not putting in last quarter here. So this is a year ago. So they did actually quarter over quarter reduce the amount of shares through their $25 million buyback. Okay, continuing. Company owned stores at end of period, 145. That was for Q1. In Q2, 200. And so you can see year over year here, you know, they opened up 12 stores. They pretty much increased this by 55. So main event added a good amount. I wouldn't say all 55 were main event. They probably opened up some Dave and Buster's as well, but significantly increased the amount of stores that they have. Store operating weeks in the period, 2,171. Let's compare that to Q1, 1,876. Yikes. Okay. And the total revenue per store for Q1 is 240. Total revenue per store operating weeks, 240,000. That would be per week per store. And for Q2, 216,000. So the number of stores did increase, but the total revenue per store went down. So that's going to explain why our operating expense or operating costs are so high. Even though we had a beat in revenue, it ended up being less net income. Each store is making $24,000 less per week. So your margins are going to be much smaller in that case. And then let's see here. Here is other costs. 13,000. No, that's $13,858,000 is amount primarily represents costs related to the acquisition of Main Event and subsequent integration costs. So, had they not spent this money on acquisition, actually did some calculations, which took longer than it should have. they're they would have let's see, where is it? Yeah, they would have had a net profit of 42,946,000, but because they had to spend money on acquiring main event, integration costs, all of that, um, their per share, had they not spent that money, would have been 87 cents per share, which would have been much better than 59 cents per share, more in line with their 2019 quarter. And that's pretty much it for this. In the conference call, they were talking about how much resources, time, and effort is going towards integrating main event. It's a very recent thing, and I'm sure it's going to take a while for those stores to smooth out. So we will monitor this. We'll see if that per store revenue is able to grow, and they definitely have more stores. So once they get their margins in line with where they were, then they should be able to drastically increase their profitability and the let's see, where is it? The PE ratio. So even though this was not a beat quarter over quarter, I wish I had a graph to show us the trailing 12-month PE ratio is going to include this quarter, Q2. They're calling it Q2 2023, but Q2 2022, Q1 2022, and it's going to include Q4 2021 and Q3 2021. And is this not going to show me? There is, here we go. So this is the first quarter of this year. This is the fourth quarter of last year, the third quarter of the year before, and the first, fourth, third, second quarter of 2021. And this, so we're going to count this current, the prior, which is this. So this current, this one, and this one are now getting included. And this EPS is 0.21, and then 0.53, 1.35, and now what was it? 0.59. Those will get included. And so the next quarter will drop off this 0.1 and instead report whatever the new EPS is, which will drastically improve the, flipping tabs again, which will drastically improve the trailing 12-month PE ratio. Because even if the next quarter is similar to this quarter, which is 0.59 EPS, it will be, at least double what the fourth quarter that is figured into this PE ratio. This will drop off, and it will average with this quarter here, the current one, this 0.53. And so the PE ratio, if the price remains the same, the PE ratio should go down next quarter. And 13.9 is still a really good PE ratio if you're going based off of that. But so they're on a good path, and this suggests, kind of what I just went over, suggests that they are at a good valuation right now. Based on the next quarter, it could be drastically better, but we will see. I don't see their next quarter being worse than this current one, unless they start to do renovations major repairs or renovations to these 50 stores that they purchased. Um, they did mention in the conference call that they're gonna do, some retooling slowly, but um, as long as they don't do everything at once, their operating expense shouldn't go up too high, much higher than what it is right now, and the net profitability should come in line. But we will continue to monitor it. Thanks for watching.